Hello, welcome to our video on theme and meme investing. Before we get started, let me go over a quick disclaimer for you. You should notice that nothing in this video is remotely related to investment advice. I take no responsibility for you losing your tuition money if, after watching this video, you make a poorly timed trade in something like GameStop or the Buzz ETF. All right, so with that taken care of, let's move on. In class, for evaluating the equity of companies, we've focused on traditional quantity methods. For example, we looked at the balance sheet valuation method and we looked at ratio analysis using market data. As you've probably noticed, there are other simpler, non-quantitative, and arguably better ways to speculate in the stock market. In particular, thematic industry and sector exchange-traded funds, or ETFs, have done extremely well since the COVID meltdown of last March. So I thought it would be fun to give you an overview of these trading and investment vehicles and to discuss some example trades. Before we get to that, let me just take a very quick tangent and let you know that I'm only going to focus on ETF speculating here. ETFs, or exchange traded funds, as you probably know, allow you to purchase an interest in a pool of related stocks inexpensively with just one trade. So why am I focusing on ETFs and not individual stocks like GameStop or AMC or something like that? Well, let me show you. So this graph, I think, explains extremely well why it's best to speculate or invest in general in exchange-traded funds instead of individual stocks. So what we have here is a plot with the x-axis, the number of stocks in our portfolio, and on the y-axis, the risk of our portfolio. And risk can be measured by probability of a loss, probability of a big loss. We'll get very specific about the risk of a portfolio a little bit later on in chapter 13. But for now, just think of it as risk as probability of a big loss or something like that. And what you can see here very clearly is the more stocks that you have in your portfolio, the less probability of a big loss that you have. And that does go down asymptotically to a certain amount, which is about half the amount of loss you could get if you had just one or two stocks in your portfolio. So that's pretty awesome. And that's why on Wall Street, a lot of people say diversification is finance's one true free lunch. So let's look at another example of what could happen if you're not diversified. Okay, so this example is pretty interesting. It's all about Enron. Enron in the 1990s was trying to be sort of the Tesla of the energy industry. And what I mean by that is they were trying to completely disrupt the energy industry. Unlike Tesla, Tesla is not fraudulent in any way as far as I know, but Enron was based on fraudulent foundations. So Enron caught on very big time, and you can see the graph of their stock up above my head here. Their stock price exploded, and then when it was uncovered that they were fraudulent, their stock price went to zero. They were bankrupt, and anyone who owned their stock got zero on that. And the reason I point out Enron in particular is because Enron had a company policy that if you worked for Enron, 100% of your retirement funds had to be in Enron stock. So many people working at Enron, when the company went bankrupt, ended up losing all of their retirement funds and got in really bad shape for retirement. And some of them are still actually acting as greeters at Walmart and things like that as a consequence. So it's a really good example. You don't want to put all your eggs in one basket. You don't want to be completely undiversified. So that's why I'm going to stick to the ETFs in this talk. So what exactly are thematic industry and sector exchange-traded funds, and why should you care? Let me take the second question first. You should care because these ETFs allow you to speculate in the stock market based on just a view informed by reading research and discussions. So things like looking at news, looking at things like Wall Street bets, discussing things with your friends, instead of having to come to a view for speculation or investment based on quantitative financial analysis. So let's take these one at a time. Let's start with thematic ETFs. Thematic ETFs are investments based on a qualitative thesis, and the thesis usually includes a view and a trading strategy. So for example, if we look at the ARK ETFs, and we have Cathie Wood and ARK up at the upper left part of the screen right now. Cathie Wood and ARK's views are first that disruptive technologies are going to change the way the world works in the medium term. And by disruptive technology, she means things like electric and hydrogen powered transport, autonomous driving, the genomic revolution, and the fintech revolution. And she also has the view that investing in these technologies now will produce roughly, on average, something like 15% annualized returns for the next 5 years. And if you do the math on that, that works to doubling your money every 5 years. So that's her view. And the trading strategy that ARK evolves from that is to say, hey, let's build ETFs from companies that are developing these disruptive technologies. Another good example of a thematic ETF is the brand new Buzz ETF with the ticker symbol BUZZ. The view behind the Buzz ETF is that prices of stocks that are most mentioned on social media favorably at sites like Twitter and Wall Street Bets tend to increase dramatically. So the trading strategy that Buzz evolves from that view is to say we're building an ETF that monitors social media sites in real time and trades on large volumes of positive and negative mentions. So what about sector and industry ETFs? These are a little bit different than thematic ETFs. Starting with sector ETFs, what they do is they put together an exchange-traded fund that contains a basket of company stocks from one sector of the economy. So for example, the XLE ETF includes a basket of companies that operate in the energy industry, legacy and also green. And the XLF exchange-traded fund, for example, includes a basket of companies that are operating in the finance industry, including things like large banks, regional banks, some insurance companies, and things like that. And the idea for speculating in these is to trade these when you have a view that the sector under consideration is either going to flourish or wane. Flourish means you'd buy or buy call options. Wane means you'd do nothing or you'd sell shares short, or maybe think about put trading, which we haven't covered yet in class, but pretty easy for you to figure out based on what we have done with options. And then finally, we have industry ETFs. Industry ETFs are very much like sector ETFs, except they're more specialized. So an industry ETF is going to include a basket of companies that operate in a single industry. So examples of this would be the IAT Exchange Traded Fund, and that has a set of regional banks in America. So that would be the regional banking industry. If we look at the TAN or TAN ETF, that is an exchange traded fund that invests only in the solar industry. If we look at something like the MSOS ETF, that includes a basket of companies operating in the United States cannabis industry. So the way to trade the industry ETFs is very similar to sector industry ETFs. If you have a view that a given industry is going to flourish, you want to buy one of these ETFs. And if you have a view that the industry is going to wane, then you'd want to do nothing or sell the share short of the ETF, or maybe consider buying puts or something like that. Okay, so enough of who's who and what's what in terms of how these things work. It's time to look at some examples. So I'd like to look at these examples from the perspective of the views you might have on these ETFs that would propel trade entries and exits. And we're going to focus on examples around the COVID crash of March 2020 and beyond. Okay, so here we are with a graph of the S&P 500 through 2019 and into the COVID crash of February and March 2020. So you can see this was really like quite a huge crash here. So the question is, what could we have done with thematic exchange traded fund sector ETFs or industry ETFs to try and make some money after the crash happened? Well, the first way that you could have done this, and a lot of smart people did this, is early in March and into mid-March and the end of March, they started realizing, especially around the end of March, that we'd all be working from home, everyone who could be working from home for quite a long time, and we wouldn't be getting out much. And therefore, we're probably going to be doing more and more on the internet just to stay connected so we don't go crazy, so we can watch films, stuff like that. So without trying to suss out who's going to be the biggest winner, is it going to be Microsoft? Is it going to be Disney? Is it going to be Zoom? Is it going to be Square? You could do something like just buy shares in the PQNI Internet ETF. And folks who did that in mid-March, late March, April did extremely well. You can see on the graph here, I have the S&P 500 again in blue and the PQNI in purple. And that worked out extremely well for people who just had that thought process, not quantitative in virtually any way, but just sort of a big picture, logical, what's happening and how can we profit from this type of approach. Next up, I have a graph here of the S&P 500 and the KIE Property and Casualty Insurance ETF. Another way that you could have approached this is to ask the question, well, what was doing well? What was performing similarly to the S&P 500 before the crash, and probably at the end of the day is going to catch up and do as well again after this COVID situation is sorted. And a fairly obvious example of that would be the property and casualty insurance industry. First of all, if many of us are stuck in our homes, there are going to be fewer property and casualty claims being made. And second of all, there's no reason for this industry not to bounce back after COVID is settled. So this would be something you could come into a bit later, something like April, May, June, and still do extremely well. Just on a personal note, this is a trade that I did make in June. I didn't do anything before June because I was working so hard trying to morph my class into an all online class. So I didn't have time for anything until that semester was over, other than Fin 301 and Miami University stuff. Okay, so another thing to think about is what's going to happen when the COVID gets sorted. What is going to come back that may have been hurt very, very badly during COVID? So some of the things that you've probably seen at Wall Street Bets are the cruise operators, Royal Caribbean, and folks like those. And I do believe there is a cruise line exchange traded fund if you want to look at that. One of the things I noticed was that starting around July, hotels and motels that you could drive to became completely booked. And in August, especially, they were totally booked. So my thinking was I don't really want to invest in Hyatts or, big city hotels. People are moving away from the cities and they might stay away for a while. But one of the safest things you can do when you're dying to get out is go for a drive with your family and stay at a hotel near Gettysburg or the Grand Canyon or something like that. So a way to express that view in the form of a trade would be to buy something like Choice Hotels. Now, Choice Hotels is not an exchange-traded fund. I consider it like an exchange-traded fund because they own so many hotels that they're very well diversified in that space. And the other beauty about Choice Hotels is that almost all of their hotels and motels are non-urban drive-to destinations. So in my view, those are going to be the first ones to come back. And you can see that's been working out pretty well also. Okay, next up has something to do with what we're looking at in class right now. We've been looking at treasuries and yield curves and things like that. So what's been happening here is that the Fed has been saying that it's going to keep the short end of the yield curve low, but as you may have noticed in the market recently, you can see this in exchange-traded funds like TLT, which inversely follow the yield of the US 10-year Treasury bond. The yield of longer dated risk-free securities has gone up a lot. So the slope of the yield curve has gone up a lot. That's in general very bullish for a whole bunch of financial companies that borrow short term, so the short end of the Treasury curve, and lend at the long end. They'll make mortgage loans or something like that, and they'll use short-term treasuries to help them get some leverage to finance the making of those ones. So a steepening yield curve is in general bullish for all sorts of places in the finance sector. So one thing that you might want to do when you realize that's happening, and that was maybe September timeframe, something like that, it was fairly obvious that we were going to get through this. We had Regeneron's monoclonal antibody treatment. We had vaccines right on the horizon, a couple of vaccines that were looking pretty good at that time. And another way that you could have played this, which is maybe more intuitively obvious, is with a regional bank exchange-traded fund. And you can see, interestingly, they both have done extremely similarly as they've started to recover. So the ETFs involved for these would be the KBWB, and that's the finance sector exchange traded fund, or the IAT, which is a regional bank exchange traded fund. Okay, so I'd like to point out that it's still not too late to think of these kinds of qualitatively focused trades that you get to by just having an informed view. What I've got here is the S&P 500 in blue and the JETS ETF in light blue. The JETS ETF is invested in a bunch of airline companies, and as we are coming out of COVID, it's reasonable to expect that the airlines that haven't gone bankrupt are going to see great revenues and pretty good improvement. And you can see that the JETS ETF was doing pretty well before the COVID crash, and it's come back a lot, but it's got a long way to go. One reason it's been lagging is because it includes a lot of international airline companies, and clearly domestic airline travel is going to come back first. So one could argue that maybe you should buy shares of JetBlue and Southwest and Alaska Air, three of the best domestic airlines, to be diversified instead of this ETF. That might be even a smarter move than buying JETS. Okay, so I hope this has proved interesting and enjoyable to you. I have just a couple more things to say before we leave. The single thing that got me most interested in theme investing, sector investing, and industry investing was an anecdote in Liar's Poker, the book by Michael Lewis. This is an extraordinarily great, extremely funny book that I recommend to all of you. So one of the anecdotes in there had to do with the trading desk at Salomon Brothers, a particular trading desk where their whole mission was to legally make money for Salomon Brothers by trading anything, trading stocks, bonds, commodities, anything they could find worldwide. So immediately on the news of the horrific Chernobyl nuclear disaster in the Ukraine, their top trader on that desk called out, "Get me maps of Eastern Europe, Western Europe, that whole region." And he pored over these maps for a few hours, and he realized that the radioactive cloud from Chernobyl was headed directly for about 80% of Europe's potato crop. So he he immediately backed up the truck going long on potato futures and made an absolute fortune. And that required no quantitative nothing. It was just smart thinking and a view developed on news and discussions with the people around him. Okay, so on that note, I'm going to call this a project. And the one very last thing I will say is that with this video, please feel free to leave comments below in the YouTube comments section, and I'll try to answer them. And we can also all, as much as you'd like, talk amongst ourselves down there. Okay, I'll look forward to seeing you again soon. Take care.